We are on. Good morning.
Good morning.
Always
Very good.
starting out with great energy. That's the way to go.
Yeah.
Awesome. Good morning, everyone. Welcome to Coffee Time with Torossian, CPA. If you are a returning viewer or listener, welcome back. We love having you here. If you are new to the show, welcome as well. Please give us a hands up or something fell. Please give us a hands up or a thumbs up in the chat so we know you are new. And understandably, that if you're a listener, we won't be able to see that, but you can always give us a like on that little audio thing. So, we know you are one of our new followers. Always I like to tell everyone to please go ahead and subscribe, like the channel or the page you are following us on and listening to us. We go live every Thursday, 10 o'clock Eastern Time, 10 a.m. Eastern Time on our Facebook page, on our YouTube page, and our LinkedIn page. I am your host, Marie Torossian. I'm a CFO and auditor, a certified public accountant, and a chartered global management accountant. I use my proprietary methodology, Valuation MT, to help business owners that achieve their first million to 10x their profits. I've also created an e-course to match with that. So if you're still in the beginning stages and you just want to go through the course, that's available to you on theprofitlab.biz/programs. I am a Grant Cardone licensee, and I coach businesses in sales, marketing, and money mindset. I have full access to grants materials, so I'm excited to be your coach. You can also find those at the profitlab.biz/pricing and plans. I've authored a couple of books, The Complete Guide to Business Growth and The Business Owner's Guide to Operational Accounting. You have access to those books on the profitlab.biz/shop. So we don't have any webinars for you to attend this week. We are working on some other items, but as always, I'm excited to have on my show my featured guest, my tax colleague, Pedro Gonzalez, CPA. Hi, Pedro. Good morning.
Good morning, Marie.
It's
Good morning. It is a
morning.
good Thursday. It is a good Thursday.
Yes. It's a very good Thursday. I had a very exciting start of my day.
Yes. It is an interesting times, and we'll be discussing a couple of things today. So, but just to get started, Pedro Gonzalez, CPA, your business and tax strategist, here to help our clients reduce taxation. You know what I mean? It's a topic, I don't know, it's in a lot of people's mind. Improve cash flow and develop exit strategies. Like I have said many times, cash flow is the lifeblood of any business, regardless of size and industry number. And then exit, we're all gonna exit. It's just gonna depend how we're gonna exit. So we're here to help you on those different areas of your business to achieve your financial goals.
Absolutely. Just chatting away here with some of our viewers live. A quick summary of some of the subjects we've covered before. We've covered financial analysis. We've covered employee tax retention credit. As Pedro mentioned, we've covered a whole series on tax planning.
Mm-hmm.
We've talked about IRS audit versus financial audits. And these are actually IRS audits are going to be coming down the pipeline. We've mentioned that quite a few times. So please make sure to go back and check some of those episodes. We've talked about ethical standards. We've talked about partnership-related sales, partnership-related agreements. So very important to business owners to know this type of stuff. One of the recent conversations we had was how to recession-proof your real estate business. And last week, we specifically talked about the Inflation Reduction Act, which passed in the Senate at August 7. And I think, Pedro, we were one of the first people to talk about it.
Yeah.
I'm telling you that
people need to be, this podcast has, I gotta give you kudos. I mean, you're bringing up-to-date information, and I hope that people appreciate that and be logging in so they can see the new information. And since the last meeting, now it's law. So the bill was not only passed but also signed by the president. So now it's law. So this is important. So stay up with us,
Yeah.
because now it's no longer a speculation. Now it's official. So
Yeah, absolutely. And we talked about it last Thursday, and how fast it passed, and
yeah,
now
yeah,
everybody has to go
yeah,
crazy trying to keep up. And the interesting thing is that this week I suddenly saw a bunch of a few other accountants that are on social media finally talk about it. And Florida Institute of CPAs, just pushing a webinar like fast to talk about it. So like I was actually surprised that we were one of the early people talking
yeah,
about
yeah.
it. So it was exciting, very exciting. But at the same time, this is now a law, and people really have to take things seriously.
Mhm.
And we are here to help. We are here to help. So today's conversation, and by the way, guys, we will most probably bring that conversation back. There's going to be a lot more to talk about on that specific law. But for today's conversation, we're going to talk about capital gains, and Pedro is going to walk us through that conversation. So there's a lot of key things that he wants to cover. So Pedro, please take us through the capital gains journey.
Well, yeah, and this is something that also is going to be a topic of conversation because of the fact of, especially here in South Florida, the residential real estate market still pretty high. In what is happening, there is going to be significant unrealized gains that are being piling up for many homeowners, and which is good, if you're ready to sell. But then
Mm-hmm.
what about the tax implications? So I was since the last podcast that we had last week, I've been approached by two individuals referred to me for consultation. One was a single woman, another one was a married couple. And so it brought to my attention, and this is why I wanted kind of to talk to you about this, and to the audience. There is a general understanding of the rules, because again, you Google it, you hear about the 250,000 exclusion, the $500,000 exclusion. You kind of know that there's a 2 year that you have to have used and lived on the property in the last 5 years. However, within that's kind of the macro, kind of view. Now you have to dive into the tax code to find out that there's in situations that you think you qualify, you actually don't qualify, and in situations where you thought that you don't qualify, you actually qualify. So I have two simple scenarios here that were presented. I kind of have to kind of brush it up a little bit and simplify it. But I thought to share it because I think it's gonna be useful for some of the people in this audience. Now, the general rule is, as we have already mentioned, that there's one test that has to be met, and that's what we hear about, the ownership and use test. That you have to have owned the property and used it for at least 2 years out of the last 5. And again, I'm making it very simple. I'm not going to go into all
Mm-hmm. Right.
the specific, but at least that gives you an idea what is happening. Now,
Of course.
however, something that does not get mentioned in that conversation is that the ownership and use requirement are based on the total number of days and months. What does that mean? What it means is that it doesn't have to be continuous periods. When you're thinking of 2 years, it could be periods of time during that 5 year spectrum
Mm-hmm.
that add up to 2 years. So it could be, blocks of time, and this is also important for people that don't live here permanently and in Florida. And it happens that you're gonna find situations where a homeowner might actually qualify for 2 properties as for the exclusion at the same time. Somebody that
Mm.
lives in the Northeast and, and,
Sure.
and shares time here in South Florida. So it's because of the number of days and months that he or she lives in each state, and it end up being that this individual can choose which of the property I'm going to use exclusion.
Understood. And this is where I think tax planning helps, right? So you can
Correct.
kind of
Yeah.
figure it out ahead of time which one you want to take advantage of, correct? Instead
Exactly.
of doing it last minute.
Exactly. Because there is and I'm not gonna dive into this specifically, but
Sure.
basically there's what we call the anti-recycling rule. Meaning that you cannot take the exclusion. So if you take one, you have to wait a 2-year period before you can take another one. So that, like you said, the importance of tax planning, because if you qualify for two properties, you got to choose where to maximize my tax benefit.
Right.
Because I cannot immediately sell one and, let's say, in another year sell the next one, and thinking I have another exclusion because I already met the requirements. You see what I'm
Right.
saying?
Right.
So
That
yeah,
makes
you're
sense.
right.
Yes. I think that that's a great way to plan for the future. If someone has multiple properties, whether they're commercial or personal, if they want to sell it in different ways, it's better to sit down with you and plan what's the best way to sell and make the most out of those exclusions.
Exactly. So I'm gonna run you here by one scenario. This is a single woman.
Mm-hmm.
Let's just call her Marie. And
God.
so let's call her Marie. Okay. So no, Marie rented a home from January 1st, 2015 to January 1st to 2020. Now she
Mm-hmm.
purchased that home on January 1st, 2020, and lived in that home from until February 1st, 2020. And then on March 1st, 2022, now Marie goes and sells the home. Now, this individual, which we're calling Marie, she contacted me for consultation because her tax preparer told her she does not qualify. And I can
Mm-hmm.
see why, because the individual is looking at, well, she bought it in January 1st, 2020. She lived in it 1 month,
Mm.
and then she sold it 2 years later.
Right.
So he's immediately the tax preparer is thinking, no, she does not qualify. However, the way that you have to look at this is that it is the ownership and the use does not have to be simultaneous or happen at the same time. So Marie
Mm.
actually qualified because she lived in it from January 1st until January 1st, 2020, January 1st, 2015 until 2020, as a renter, and lived in there from January 1st until February 1st as a homeowner. But the
Oh,
use of it
understood.
actually counts. It's the same
Understood.
location. She was first as a renter, and now she's in the homeowner. Now she owned it from January 1st, 2020 until March 1st, 2022. So she meets both requirements. She doesn't not meet them at the same time. And this is a
Right. Right.
misunderstanding that I have to use it and own it at the same time, and that's not correct. That's not what it says. Is you have to have used it, and you have to have owned it. So anyways, that was good news for her. She was quite happy to hear that, because otherwise she would have had to unnecessarily pay. She does have a substantial gain that exceeds the 250,000 exclusion, and but she can use that 250 to at least minimize the impact of the tax that she would otherwise have to pay.
Yeah, I like when you give examples. I think our viewers and our listeners can make a better,
Yeah.
it's easier to understand, right? When we put it in an actual example, that's a lot more helpful. I like that.
Now, the other scenario that came to my desk is, and it's amazing. This is since the last week we talked. The next one is a married couple. Um, and now, what happened in this scenario? Let's call them John and Joanne, and they get married,
Hmm.
and they decide immediately after the marriage that that each one own their respective homes, and they get married, and now they're deciding, well, we don't need two homes, so let's sell one. So they
True.
decide to sell John's, and let's move on into Joanne's home. Now what happens is that John has meets all of the requirements prior to marrying Joanne. You know what I mean? So he owns the home, he has lived in it, and so no issues there. Now in their mind is that uh, they're thinking, well, we can use exclusion, the $500,000 exclusion. This couple is expecting over $600,000 in gain on that transaction of the
Wow.
sale of the
Yeah.
John home. But they're thinking, oh well, we can use the exclusion. Unfortunately, that's not the case, because Joanne has not lived in that home the 2 years. So it was not the positive result that we're looking to validate. And actually, in this case, their tax advisor gave them the right answer. They were seeking, I think they were seeking somebody to counter the advice that they already had on hand.
Wow.
Yeah, unfortunately, in this case, I could not. There was no an alternative. Now, what I can tell you as far as the educational points, because this happens quite often, and those are situations where you have again two single individuals, each one with the respective home. Now they decide to marry, and they gotta sell one of the properties. So the tip I can give you here is that instead of selling immediately, is that you could move into one. You can still rent, and this is something else, a misconception that people have. I cannot rent and then live in it again. You could rent one, live on one. Let's say that they decide, and again, the tax planning. Let's say we're gonna sell John's, and so
Right.
let's move into John's home at least for the 2 years. So then at least I secure the 500,000 exclusion that is still valid as of today, and I can use that to mitigate or eliminate any gain on that sale. Then I can move back into Joanne's home, which I have been renting, let's say, for 2 years. And then now we start the process in Joanne's home.
Right. Understood. And would it have made a difference if they were filing as, say, let's say, married filing separately, or?
No, that's a good question. No, now they don't. This couple didn't get zero. What happens is that he can still use 250. So, but they still have to report $350,000 gain. So,
Right. Okay.
Kind of where you're going with this, yes, each one has their own separate 250 to begin with. Now,
Okay.
what happens is a married couple can take 500,000, but since she did not live in the home for the 2 years, she
Understood.
can use her
Yeah.
250 to combine it with his. For the home tax.
Understood. Yes.
Yeah.
Yes. So he still gets something. It's just not
Correct.
the 500 they were
Correct.
expecting. Understood.
Yeah, they were expecting that 500,000, but then in this case, they didn't get the answer they were seeking. But I thought that this is a situation that I think we're gonna see a lot on 2021. Those people still have not filed. I think you're gonna encounter either people that have misunderstandings about the application. I know they might seem like a simple thing because people, you Google it and it's all over. The 250, 500,000, the 2 and 5 is but there is actually little intricacies within it that can be like a minefield for you. You know what I mean? That you think you actually know and you don't know. You know what I mean? And there's some moments that you qualify and you don't know you qualify and you incorrectly pay tax and when you didn't have to. So
those are really, really great examples, Pedro. Thank you for sharing them. Love it.
Good.
Awesome. So on my end, one of the new things that came to my desk, and it's always those exciting ones, and I think people find me. I guess I'm really a master at it. It's the cleaning the messy books. That thing.
Yeah.
So this week I'm actually collaborating with another CPA that has a client with the books completely messed up. So the 2021 books were so bad that looking at it, it was just literally like accounts receivable were showing on the balance sheet as in the negative.
Yep.
There was accounts payable showing in the negative.
Yeah.
So it's like, and already from there, we're like, oh,
Correct.
whoa,
Exactly. Red flags.
Massive clean up.
Yeah.
I think a lot of times I'm not sure as business owners what they're looking at, and I don't know if they're ever looking at their financials, but these are simple things that when they look into their financials, these are red flags right away. So imagine you try to do a tax return, you send that to your tax accountant, and a lot of times, Pedro, I mean, you're a tax accountant, right? So you would look at this, you're like, well, I can't work with this.
Correct. No, I know.
I can't work with these. This is all wrong. So, and this is where, we work together where, one of us cleans the books, the other one is doing the prep and filing and the planning. So So this is something that we're going to be literally going in. It's going to become like almost like a mini audit, right? So we're not going to be doing any, we're not going to be doing any kind of, let's say, audit in the sense of giving an opinion, but we need to go into almost every detail and match deposits to every
Yeah.
receivable. Literally backtrack every single, um, you know, a bill that was recorded, and then if the deposit was actually matched to it.
Hmm.
So that's only from the receivables, right? And then same with the bills that were recorded, and then we don't even know if they were how they were paid, or some of maybe deposits were put in the bills.
Correct.
I don't
Correct.
know. There's so many things that could have been posted so wrong. And then other things that were, a lot of red flags that we see sometimes. And for example, in these books were, when people have, let's say, a suspense account, what does that mean?
Yeah.
That is a red flag to me right away. When I
Is
see a suspense account with a $1.5 million in there, I'm like all
Yeah.
like bells and whistles and red
Yes.
flags. Like, it's like, what are you hiding in there?
They don't realize how
I mean,
how is so like you said, those are that miscellaneous, another one that tends to catch a lot of attention from the IRS. Those like you said, suspense, ask my account, and they are to put it like that in the tax return. You know what I mean? Suspense,
yeah,
ask my accountant. Miscellaneous, miscellaneous is another one. The IRS knows that that's a dumpster. You know what I mean? That people just
yes,
throw stuff in there. So, anyways,
yeah,
I just
yes.
yeah.
Yeah, that's one. And let's see. I'm trying to remember some of these things that I saw. Um, oh, so other things that we noticed, let's say, certain types of equipment that seem to be so massive in amounts, right? That were on the profit and loss statement.
Mhm.
So, and certain, certain people like business owners, they'd be like, well, it's actually tax deductible. Well, yeah, the depreciation.
Correct. Exactly. And yeah,
So you don't expense it, you capitalize it, and then we
exactly.
depreciate it at an X amount. You let the tax accountant do that.
Correct.
So we have so much cleanup to work on that it's just crazy. It's just crazy. Like, literally, we will have to go line by line in the profit and loss statement, line by line. Every single GL account to see what is in there, why it was put in there, and almost reconfigure the whole books before the tax CPA actually does the work.
Yeah.
So, and I really want to bring this up because, like you said, with 85,000 new IRS agents being hired under the new law.
Yeah. Yeah. No, listen, regardless of what that number actually will
Yeah.
end up being, because again, that there's debates about the exact number, but it will be a significant, and the IRS has made a focus on increasing their compliance. You know what I mean? Increasing, in essence, what that means, increasing the audits. They're not saying that. They call it increasing compliance. It's increasing audits. And so I'm not here to scare people. Is to prepare. You know what I mean? That you ought to invest in good accounting, like
Yes.
and we have mentioned this many times. I mean, it's the value of that, and having good documentation. One is that
Yes.
your solid bookkeeping backed up by solid documentation. And I
Absolutely.
can tell you, as a tip, a suggestion for the audience is the areas that I would highly recommend, in addition to major purchases, like you said, repairs, capital improvements, like equipment and things like that, but
Absolutely.
also areas that get neglected, travel and meals. Those are two areas that the IRS typically will go after because they know the people tend to be very lax on that area. It's an
Mm-hmm.
easy target to knock down something. And I'm not here to put down the IRS. I'm saying that, as an
No,
auditor,
but
it's an area that I know that there could be a weakness. You know what I mean? So when we're auditing financial, we look for
right.
weaknesses. So that's an area that can easily be targeted. And I know that there will be some weaknesses in there, meaning that you don't have the documentation, you don't even know who
Mhm.
you met with.
Yes.
You don't know what the discussion was at that meeting. The travel, you they have to have a business purpose. I mean, so make sure that you
Yes,
document
of
that.
course.
Yeah.
Of course. Yes. And then some of the other things that we see a lot, and in this case, I saw it as well, is, in the owner, you see them drawing massive amounts of money. And when you ask them, what was it for? It's like, it's very vague. So you better prepare something really true, and the real purpose of that withdrawals.
Yeah.
Because if it's by any means something personal, let's say you wanted to do some type of renovation for your house, that's fine. It's your money. You can take it out, but you might as well maybe have to pay it back to your business because that
Correct.
wasn't your business, or it's a distribution to yourself. So you want
Exactly.
to make sure that you're capturing that information properly.
Yep.
So, when you see those types of monies going out like that, you can't just leave it like that. So we have to ask those questions. And I know a lot of business owners become a little defensive when we ask these
Yeah.
types of questions. Just be ready, because we are doing our job. We are doing our job to help protect you more than anything.
Correct.
So be ready for those questions, because we're here to protect you first.
Correct.
So
Exactly.
doing our job.
Yeah. And no, it is better that they have that conversation, as uncomfortable it might be. It's better to have the conversation with you than
Right.
me
Of course.
discussing this with an IRS agent. You know what I mean?
Yes.
It's better because Marie at least can help me either or what kind of solution. Let's say I took the
Right.
money in excess of basis. This is an area again, Marie, that is going to be heavily audited. That's going to be, and especially S corporations and bases, because they know that a lot of people are taking money out in
Mhm.
excess of basis, and they're not reporting that as taxable dividends
Yes.
because there's a limitation of how much money you can take out. However, there's a solution for that, and this is where somebody like Marie comes in and say, well, okay, so we are in excess of basis, so let's classify this. One option is a loan, which
Right.
then you
Right.
repay in that way. But again, all documented, like you said, everything
Absolutely.
documented, and everything is a repayment plan and so on. So then if you get audited, the IRS can see that the backup and why you're calling this a loan.
Yes. Yes. Absolutely. Absolutely. Yeah. Other things that I've seen is, advances to employees or a friend
Mm-hmm.
or
Yep.
a
Yep.
family member. There's no such thing. It's a loan. And you better have a good documentation with at least a fair interest being charged from your business. That is going to be required, so we can document that and make sure that we're accruing the interest on that loan and making sure the balances are correct. So those are all kinds of things that we'll be looking at, and as we're fixing, messy books.
Yep. Yep.
So I get really excited about these things. I mean, they are challenging. It does take time, and it does take a lot of effort. And a lot of times in these organizations, they do have maybe a bookkeeper, maybe a family member that's doing it that doesn't know what they're doing. Um, this is where you and I always keep repeating this, is like, you're trying to save money, you're trying to save a couple of bucks, but then you have to come and pay 5 times the amount to have someone like me come in and fix, because now I have to work backwards and I have to make sure all these documents are available and ready and everything is done correctly. So if it's done correctly the first time, you wouldn't have to go through a cleaning process. So yeah, I mean, these are very, very interesting areas that I've seen it happen over and over. It's just, but it's very important to make sure the books are cleaned up. Yeah. So that's going to be my project working on. Coming at the big project.
Awesome. So maybe you'll give us an update.
Yes, I will most definitely give an update on that one.
Other lessons we learned.
Love it. Let me see if there's any comments, guys, for those of you watching. I know I'm seeing some laughs about the messy books, and I can imagine sirens and helicopters.
Yeah.
And yes, so yeah, we do have fun talking about this stuff, but at the same time, truly the whole point of this coffee time and bringing you this information is to help you, to help educate you, to keep you out of trouble.
Yeah, exactly. Yeah.
Help you mitigate risk on the audit and tax side of things, so you are knowledgeable. And if you realize you've done something wrong, just come to us and we'll help you get things corrected, and yeah, help take care of you. And any other thoughts, Pedro, before we kind of close today's session?
I have. I'll make it very short and sweet and to the point. What Marie is doing is beyond. I don't know if people realize the value that is being put in here. You know what I mean? That not only on this podcast, you should go into her project of the Profit Lab. I mean the content and the time, the things that people don't realize, the time and the effort that goes behind this. But that's beyond the point. The thing is that when you go back and you see the amount of content that she has put out there, the value that is being compiled from another professional to another is, is great. I don't see this happening out there, especially for the mid and small businesses. You know what I mean? This type of information is discussed in round tables between, big corporations. But for the small business to be able to access this information, and you're doing this almost daily, I give you,
Thank you.
a lot of respect from one profession to another. And what I would encourage people is to, at least as a minimum, at least subscribe, share, to help this type of content to continue. Not only this podcast, but look at what she's doing on other projects that she's putting out there, and do the same. You know what I mean? Like it, so then this information continues to be disseminated.
Thank you. I appreciate that, Pedro. Thank you. It is quite a lot of production.
Yeah.
And it's not like a full studio. We don't have any the production team here. It's it's me and a few of my staff that kind of help each other put this whole thing together. So I appreciate that. It does take a lot of time, and I appreciate you coming on board, sometimes giving me ideas on what to talk about. Hey Marie, I got this unique situation, and why don't we talk about that? And that's very helpful too. So I can't always remember what to talk about, or with all the different things as business owners that we're working on. So I appreciate you being part of this project. And with that, so guys, thank you so much, everybody, our audience, our listeners who joined us today, Thursday, August 18th. We are already, I think, episode 46. Woo! I love it. I want to leave you guys. I always leave you guys with a quote from motivational speaker Jim Rohn. You are the average of the 5 people you surround or you spend the most time with. I hope we are 2 of the 5 people you are spending your time with to learn and grow your business. Until next week, I wish all of you a blessed rest of your week. See you next one.
Take care.